What's going on, everybody? We are back. Welcome back to the Vant Rant podcast. Man, it feels good to be back. It's good to see everybody. It is Fed Day, baby. And we couldn't help ourselves but to get on the show and have this lovely party with you guys because, man, we had a great CPI day yesterday. Today's going to be a fucking fantastic Fed day. And happy Fedmas, Mark. Mal, Mark, Chris, Michael, Bornlam, JT, Desire, everyone's in there. So we're excited, guys. Super excited. Mike, are you as stoked as I am?
Oh my God. I love it, man. I tell you what, we had a great CPI day. And I apologize. I kind of basically zoned out during CPI day. I was sick. And then all of a sudden my trades are going all over the place and, we're making money and, we're hitting like take profits and, obviously the number leaked and people are trading it before. It was just a crazy, crazy CPI day. So now I guess we're in for another one, which is now Fed Day. And, I kind of equated it, right, Ty? CPI, if CPI was Christmas Eve, then...
That's right. What makes
Santa
sense?
Powell is Christmas.
Merry Christmas. Powell's coming down the chimney, baby.
So Merry Powellmas.
Merry Powell.
But it goes back to think about it with Christmas. What's better? What do you like better? Christmas Eve or Christmas? Because they're both different.
It's two completely different vibes, which is what you're getting. And there's nothing like the butterflies on Christmas Day when you're about to open the presents and Santa's coming down the chimney. And so I'm ready to open up the dot plot, the Powell predictions. It's like opening up new presents in the morning of Christmas. I got butterflies.
Yeah, I'm pretty stoked. If anything, I'm pretty stoked just to get through this.
Yeah. To
get it out of the way, to get this week out of the way. I mean, look, we talked about it earlier. We talked about it on your show yesterday. There's a lot of cross currents going on this week. Okay, I know we got quad witching on Friday, but to me, more importantly, we have S&P, NASDAQ rebalancing, which brings the larger flow from the institutions, which is what pushes around the market. And so you have all that. We got retail sales, got PCE, sorry. So we got all kind of things going on, and the fact of the matter is we got through the first one and it did not disappoint with volatility. And let's talk about CPI a little bit, Ty.
Yeah, so yesterday was nuts. So CPI obviously came out and it came in a lot cooler than everybody was expecting. Now, I know Bornlam came in right in line for Bornlam's predictions. Came in at 7.1% CPI did versus a 7.3 expected. So it came in really cool. And so, I know the Fed they were talking about before, well, one inflation print cooling off is one thing, but let's see if we can get a continuation, and we're getting the continuation. So, I mean, we had...
Yeah, I mean, my thing is with the market, it's already priced in peak inflation. Okay?
Yeah.
So, number one. And number two is we kind of talked about the setup yesterday, and we were kind of spot on, even though we weren't spot on for the second straight month on CPI going into the print. But we were pretty spot on with the reaction. And, I told you guys not to chase, that we thought there would be a lid on the market as far as the reaction's concerned. But, because we have, basically a Fed day. But I did not expect the crazy move of retracing everything. Did you? I mean,
No,
did you expect they were going to retrace the gap
I didn't
in one
expect
day?
it that quick. It was interesting. And now you're right, because on your point that peak inflation is already priced in, what does that mean? Well, you can tell in the markets. Obviously, they completely retrace that entire move right away, meaning they don't care about inflation right now. So you're right. I mean, that just tells me what what investors and consumers are thinking right now. So
yeah, and that's part of what I talked about yesterday too, is I believe this market's switching from an inflation narrative to a recession narrative. And I think we're in that transition. So, and I talk about this, we both talk about this all the time, to be a professional investor, one of the key things that you got to realize, if you want to do this for a living, where you're making a living off this, you got to be able to recognize when markets change, right? And so the last 3 months, we've made our living, and a good living, basically following the dollar around like a lost little schoolgirl.
Yeah.
Okay. It's been the three horsemen. We've had the dollar, the VIX, and the 10-year, the TNX. And we followed them around like, they had a pot of gold and we were going wherever they were going. Okay. Yep. So you've seen some dislocations in that recently. And I think you're going to continue to see dislocations in that, because I think that all harkens back to the narrative that we're switching from looking at inflation to really looking at this massive recession everybody's worried about coming next year. So I think with that, look, if you're switching, how do you know that they're switching to that narrative? Well, if you're talking recession, what typically would happen to the dollar, Ty?
Well, the dollar originally would go down first. You would have that drop, and then later on you would have that nice rally, but you would have that initial drop in the dollar.
Right. So, you could definitely see possibly that happening. So, I'm kind of looking at that, and I don't believe the market has at all priced in a recession. And, going back, let's kind of close the discussion on the inflation narrative, because we really didn't have a chance on the show yesterday to kind of talk about what we saw, right? We were just all busy counting our profits or figuring out what our trading thing was doing. But anyhow, I mean, the one thing you're noticing in inflation is that goods is starting to fall off, right? And you're starting to see it be replaced with services inflation, which the majority, we're talking about, also included labor, which is a big deal. And of course, shelter is not coming down like everybody predicts. So, get off that narrative. Okay. So, the point of the matter is, though, what I haven't heard anybody talk about is that the CPI, how they calculate the CPI, every 2 years, they basically refigure out the weightings that they give everything in the CPI. And this January, we're scheduled for another kind of revision in weightings, the last one being the pandemic. And currently, the CPI is really tied, heavily weighted towards goods. And that came out of because of the pandemic is when we kind of, when the last time they did this, right? And so now you expect to see more of a switch, maybe a little bit more of a weighting back to normal, maybe a little bit more back towards services, which I find interesting because you already have, and we know CPI, goes up and down. If you look back at the 70s, you kind of get a good, equation out of that. But the point is that the point I'm trying to get to is that, we could see some artificial shenanigans going on just by waiting. And I think because of it, they do switch more towards services, that you will see that. And what's important to me is, again, this is the second straight month we had a drop, but a lot of it was attributed to healthcare insurance, which is, dropped 4.3%, which is just a made up number that they throw in there.
Yeah.
So I find that interesting. And, so if we're going to go with that narrative, I'm going to share you a chart here. Okay. If we're going to go with that narrative, you can kind of see, goods, kind of led us up as from the inflationary standpoint. Now you see goods kind of falling back here. And then you got services inflation kind of, meeting and getting ready to pass. So if they're going to make that switch and more heavily towards services in January, then you could see an artificial bump up in inflation. And again, January, you have the healthcare insurance now is going to be, they're going to be revamping that as far as the placeholders concerned to get out of the end of year catch up. So a couple things that I was just thinking about there, and I kind of wanted to point out about the inflation narrative.
Yeah. Yeah. Well, look, if you're trying to hang your hat on that stuff, good luck. But inflation's now really doesn't really care. We have the 23rd core PCE index, which is the next big inflation print for the Fed.
Yes.
So but other than this, really, I think that this sets a big pace for what we have moving forward.
No, I agree. And if you look here, Ty, we talk about the 70s so much, right? Because that's the last time we had this type of inflation. We have to go back that far. you can kind of see what happened here. Almost at the same point, you had this drop off that, kind of pulled back in, the CPI did, into this almost 5% range, kind of cooled off just like we see now. And then look what you got, a couple years later, you're almost like, a third higher than it was before. So this is kind of the narrative that a lot of people are looking at. And it's why you kind of, if you look at the markets during that 70s and 80s, early 80s, it was kind of a channeled market. And I think that's kind of the market that we may be looking, that we're going to be heading back to as we go forward. So I just kind of wanted to bring that up as, we were talking about inflation. And, again, I think it's all about looking at the labor market. And we said that the last time we had the Fed, right? We said, what do you focus on? Don't focus on a lot of this other crap. I'm focused in on labor.
Yeah, I mean, the Fed's been really focusing themselves on the labor market imbalance. That's what they've been saying this whole entire time is, we're focusing on the labor market imbalance. And so that's definitely something that you want to keep an eye on moving forward as well.
Yeah, I agree.
But yeah, I mean, we don't have the Fed until February 1st again. So, I think people are really looking at this Fed day today to really dictate, what's going to happen the rest of the next, the rest of the year and the first period of the new year. So definitely going to be something to watch today. But I didn't look. I mean, I didn't take any trades today because there's really nothing setting up for me in front of the Fed. But there's a lot of interesting levels that are coming into play as far as the dollar and commodities go. But did you take any trades today, or are you looking at anything in particular?
Nah, look, I took some stock trades. I made some. It wasn't green, but didn't take many. There was some trades I held off of that would have worked out well, but just trying to be, like you said, if you don't have an edge in the market, wait.
Yeah.
And I don't think there was much of an edge in this market.
Fed days, you really don't have an edge until Fed comes out. So.
Yeah, and that's the thing, guys. Look, and this is, to me, this is a really important point. Guys, if you don't have an edge, and you don't know what your edge is, stay out of the markets.
Yeah.
Right?
That's the biggest thing with trading, and you can go watch my last video I talked about. Having an edge is like really everything in trading. So if you don't have that edge, there's no reason to trade.
Yeah, and if you got that, I love what you said yesterday, you're a degenerate gambler.
Yeah.
Right? If you got that little degenerate gambler in you, and a lot of us do, that's why we're trading, put on a small contract size that won't hurt you, and let it fulfill that need if you have to, right? Because we're all human beings, man, and trying to get rid of emotions is nearly impossible. That's the mistake people make. So if you do got it, get in there, just do it with light contracts.
Scratch that itch with the light contract, as Bornline would say.
Scratch that itch. Tyler scratches that itch with a freaking ladder.
Yeah, exactly. That's what I'm saying. I can fucking take that big ladder and scratch it because I'm going in full size, baby. But no, but I want to, I guess in the next 20 minutes we can talk more about the Fed and levels and what we think is going to happen as far as predictions and stuff. But what are you, I guess, looking at currently? And I guess in the stocks or equities and
yeah. Before we get into what the Fed's going to say, let's go through the charts.
Yeah,
let's go through some charts and let's see. We haven't done this in a while with you guys.
I know.
I do it every morning with the mentor group, but I haven't done it. We haven't done a show, so this is pretty awesome. Okay, so looking at the SPY, look, the monthly chart, interesting, kind of hanging out here. You got 2 straight wicks that we're working on. We're not even halfway through this month, or getting close to being halfway through. So you kind of maybe discount that for what you will. But to me, looking kind of positive there with those wicks hanging out at the upper time frames. On the weekly chart, this is interesting. So yesterday, you can see we've been working off the COVID lows, this little trend line in here. It's interesting, went right up to this 50 on the weekly. And it's been a key rejection point in here. So rejection here, a nice little rejection here. But we are back above this trend line, so it's going to be interesting to see what that means. But I love looking at the daily chart, because look at that.
Oh my God, dude.
Look at that. We gapped and crapped, man. We haven't had a gap and crap in a long time. We gapped above, by now, this is what I hate about Twitter and all that stuff, because now everybody's looking at the same shit. Okay, because they just steal what other people were doing, which kind of pisses me off, right? And so everybody looking at this trend line up from COVID highs, and you get a nice little gap up, and then they just crap it right down, and they took it right down below the 200 and closed it below the 200, which I thought was interesting yesterday. So nice little rejection. Now today we're back above the 200 going into the Fed, but again, that's I'm not really, I'm taking that with a grain of salt right now.
Yeah. I mean, like, it's interesting because every time we've had some type of massive gap, I guess crap at this area here, it's kind of signaled, if you even look at these past times, it's kind of signaled that, hey, this might be, the peak of this move here. And so we're now the massive shit bar at this trend line here. That maybe maybe a signal some type. So it's something to keep in mind there.
Well, again, I mean, typically, right, and that's what you and I look at, Ty. I mean, typically this type of trading action is very bearish.
Right.
I guess we'll just have to see. Yeah. We've got another fundamental news event.
Exactly. 100%.
And here's why I'm excited. Okay, here's why I'm excited about a Fed day. If you ever wonder, well, Mike's crazy. Why are you excited? Well, I plotted all the times that we've had Fed days. Okay, over here last year, or when Powell's had his day. And this is why you get excited about a Fed day, right? Because they're typically the start of a nice little move.
Yeah. So
if you can catch the trend, I mean, look, back here in, when was this? It was back in January, had a nice 6.5% move up out of the Fed. Okay. Then back here in March, which was a dot plot. Okay, had a nice 8.5% move in the Fed. And then, when we kind of hit in here in May, look at this. Nice 11% move down from that Fed meeting. And then this Fed meeting back in June was kind of, we kind of went down 5%, up 8%, so not much. This one right here, though, 9.3%, and then look at when Jackson Hole obviously was the meeting of all meetings. That gave us a nice 17% drop, and of course we had a Fed after Jackson Hole, which of that 17 took us down another 7. And then the last Fed meeting, we've gone up 11%. Ty.
Yeah. So I mean, we're in store for another decent move, hopefully. I mean, it's also the last meeting of the year. That's probably, bigger than inflation goes. So this should give us a nice continuation or, continuation one way or the other, that is.
Yeah. Yeah. So you can see, I mean, definitely, it's, Fed days have been, you see right in here, kind of started a counter trend rally right here, started a counter trend rally, here kind of continued the rally. And then here was, really you can almost consider this a bottoming, a counter trend rally. And this continued that rally. And then, Powell brought us down and counter trend down. The Fed continued that trend down. And now we're up. And, what's interesting, you had Fed kind of bring us up from here. And then Powell tried to bring us up from here, but we're kind of sideways. So maybe now we're due for that counter trend down.
I was going to say, if you go with the trend it's been, is you've been, in twos. So, and you had the Fed and Powell just recently. So now we continue down.
Yeah. Yeah. I agree. So we'll have to see, obviously. Look, I think either way you look at it, we're getting towards the end. Okay. I personally feel like they're not going to hike again. I personally feel like this is the last hike. They've typically have, hiked through 22 months, and that would bring us right up into this month here, being the last hike. So we'll see. But I don't think you're going to get that today, as far as that wording, but we'll get into that when we talk about it later. Looking at a 4-hour chart, I didn't get a chance to go over this with you yesterday, Ty, and, you're like the 4-hour guru. I want to get your take, because if you're kind of looking, and I'm not only going too close, but I will first, and I can back out. You got this nice expansion bar, right? Initiative bar up, and then you got this engulfing bar down.
Yeah.
What do you typically look at when on a 4-hour chart when you see such a setup?
Yeah, that's something I look at all the time, and that just tells you that there's a massive amount of liquidity sitting where that move was. Because if you had a big move up and then price is not accepted, price is not accepted here because then they sold it right back down and engulfed it. So this area is a tough mother effort of to break through, and that just really just seems like it wanted to grab liquidity. And with this 4-hour chart here, though, this is a perfect angle because I wanted to look at this area here. I always look at areas that have massive volume moves in them. And this previous area that we had a massive volume and then follow through is where we had that big 4-hour push up and then that nasty bearish engulfing back down. And so we're rejecting. There's a bunch of sellers here that didn't want price to go back through here and then it sold it right back down. So it just tells me that we could be reaching an area that sellers come into play and knock it back down. So we'll see.
Yeah. I mean, it's just crazy, man. Crazy action. So I agree with you. It's definitely a high level of congestion and liquidity in there. So they're just basically eating it up. And if you look at the 15-minute chart, you can see. And actually, let me expand this out to at least 30 days here. You can see over the last 3 or 4 weeks, we've just been in this sideways consolidation. So they took us out of it just like they did here. What's interesting is, though, out of this break, they did take us back to the bottom end of this channel. Here we break, come back in the channel. And now we're back above the channel. So maybe that's a little bit different here.
Yeah.
So
yeah.
I find that interesting on that 15-minute. On the daily chart, I mean, look, we're just kind of flagging around here, finding some support. Not really doing much. We are above the 200, and ever since we got back above the 200, and you had a nice big bar off the open out of the 200 here. So now that we're above the 200, that's obviously the first line of defense on the downside. Tech. Let's look at tech running into the 100. So definitely, weak. But IWM, which kind of led us up here, broke through the 200 first, with the Dow, and was kind of been strong. You got this trend line here in IWM, small caps. You got this rejection after busting above it. You got the rejection at 200, and it hasn't come back at all. So hanging down at lows here, and the fact that IWM small caps have led us up definitely is something to kind of watch. The Dow, I don't even care about the Dow. Okay, it's 30 bullshit stocks that don't mean nothing to me.
Yeah.
Now, we've been running with this thesis here, and we talked about this every time VIX has been in this area. We had a nice run, and last time we were on the show, we kind of foreshadowed the run out of here off those lows, right? Because every time the VIX was up here, it's really pushed us into a nice little rally. So these levels really working well through this bear market. What's interesting though is that now we pushed out. You had this long drop in volatility out, because you had a big event, that went and came and went, which was CPI, and now kind of a little drop in volatility. See, this right here though is exactly why I don't like to play options. I don't like to trade options at all. A lot of people that if they bought the wrong options made zero money on the CPI move, even if they bought them in the right direction, because of look at the suck out of implied volatility.
Yeah.
So and the one thing we talked about is the SPY. Look, I mean, yesterday's CPI rally was a sell the news event.
Yep.
Okay, we had a 5% run just from a day and a half ago, 2 days ago. So kind of sell the news event. So if you bought into the close, you bought at the high, and this thing got sucked out and you didn't make any money. So I really hate trading options because of that, especially in these type of news events or earnings. If you're day trading options, that's a different story. But that's why I switched to futures.
Yeah, if you look at the trends, or I guess the pattern that we typically get with the volatility here after we leave this zone here, so you get a nice run, a pullback, and then an acceleration, right? You had a nice run here, that pullback, and then acceleration, and we're now hitting that same zone here that we always get that pullback from. And so now I wonder, do we stay with trend and we get that nice acceleration off of the volatility here? So it's something I'm keeping an eye on there.
Hey, be careful what you're drawing
I draw
cock and
penises over
balls
here.
on
Yeah, I
there.
know.
Jesus, come on. I know what you're doing. I
Couldn't
know
help
what you're
myself.
doing. The cock and ball
Oh
pattern.
my god.
Oh my god. The dollar, I mean, look at this active sequence. I mean, just an active sequence down, which to me is just screaming recession along with the bond market.
Yeah.
So again, that dislocation we talked about, here you see it. You got the Dow up $230, right? But you got you know, the dollar. I mean, I guess it's kind of correlating, but I mean, I don't know. I typically you would see, I mean, look what the dollar did yesterday and what the markets did. So, you know, I think you're getting a little bit of a dislocation, and I think you're going to have this fall off. And, you know, typically we do the inverse, but what's going to happen here is you may still get some rallies or some sells coming out of a down dollar. So just be careful that dislocation. The rates, as you expect, going to a Fed meeting, kind of the calm before the storm. But I noticed they are holding above 3.5, which is important for me. It's important for the markets. Yield curve still inverted, still kind of hanging there inverted. So, and that's a Fed induced inversion, but screaming recession. Bond market kind of screaming recession. And you know, the oil market was definitely doing it a couple of days ago, but now we got a little rise out of it. So Ty, why don't you take over the charts in here and talk about? I'd love to get your take on the dollar. I gave you my take. I'd love to get a take on oil because you know, to me, you know, the asset classes that we're trading with stocks and stuff, you know, we've been kind of, you know, diving in your market here. So I need to understand what your viewpoints are.
Yeah, it's interesting. So with the dollar, it's kind of weird because we're seeing a little bit a change in market condition to where typically that, you know, we've had these rate hikes, we've had inflation come out, and the dollar has more or less been the inflation hedge. We've seen the dollar over gold, the dollar rising off of me because, you know, inflation's hot. That means the Fed's going to raise rates. So we've seen the dollar rally off that. But now we're seeing the dollar kind of just fall through, break structure here and start leaking off. And now if inflation isn't really the focus anymore, then, you know, what gives us that dollar pump here? And so it's going to be interesting to watch here. But the main thing I'm watching is because, you know, you've seen clearly that the Fed's just been propping this dollar up and sending it up every meeting. We've topped off the Fed meeting here, didn't make it go anywhere, lower highs and dropped. And so I don't know if we get any type of directional movement. Like, you know, you've said we've been following the dollar for everything. And now do we still follow it because it's not really focused on the same fundamentals that it was focused on, you know, this whole entire year. So I am keeping an eye on technicals here because if you look at the monthly chart, and let me just, if I get rid of some of this, these drawings here, it'll help you kind of visualize it a little more. The monthly chart is sitting at a very important inflection point, probably the most important inflection point on the entire chart here to see if we're going to maintain a bullish stance or not. And so if you, it's this purple line I have drawn. It's like more or less a zone. If you have it drawn back all the way back from 1980s, it's been the peak in 89. It's been a peak in 99. It's been a peak here in 2017. It's been a peak here in 2020, and it's now the only area we've had bearish movement from this entire bull run right here, and we had a rejection, and then it obviously then went through. So this is a major area for the Dixie to maintain if we continue on this bullish rally. We're now sitting at 50% retracement, well, almost 50% retracement of this entire move, and it's coming up to pretty much right around where we're sitting at for this monthly level. But if you look at the overall year to date from January, the open of January, we're sitting right around the 50% mark right here. So kind of a bunch of stacked levels as support on the Dixie. And if we don't maintain a bullish stance here and put up a fight, then I mean, it's not looking good. And if the dollar just keeps falling off, does that mean we're going to start pushing into a recession here? Because it's not definitely not helping inflation with the dollar falling off like this. So definitely something to keep an eye on, because along with the Dixie, gold is
There's gold in those hills.
Gold's at a massive inflection point too. I mean, if you look the weekly chart, it's been a major area of inflection. You've had the 2022 in here, you had the of May and in September. It's just been a really solid level that we've just retested many times along this last couple of years here during the pandemic, and we're sitting back at it again. And so it always puts up a fight here and always struggles at this 15 area, 12 area. And so we're at it again. And if you look at this overall breakout here, it's one of the most recent intersection points of this breakout of this trend line here. We're now sitting at almost a 50% retracement of this entire down move here. So a lot of things are coming into play here that could really signal, well, okay, we're going to continue back on the same rally that we've doing for the dollar and stuff, or we're getting a complete change in character and we start breaking levels, and now gold comes more into play now because of the Dixie not really responding to inflation or the Fed anymore. So today's going to tell you a lot. Pay attention to the Dixie, because today's going to tell you a lot moving forward what's going to happen across the markets, because the Dixie is not really our inflation hedge anymore. It's interesting. So we'll see what happens there. But
I think the world's over, Mo.
Yeah.
I'm buying my bunker, but the world can't be over because there's shenanigans going on again. So the markets, yesterday we had this nice pop up in the market prior to the dollar. Now we got a nice little pop up in the markets now. So
yeah, I was talking to Mo about it before this morning, and it's one thing to have inflation go from like 9 to 7%, but to have inflation go from 7 to 2%, if it's going to take a freaking recession or something. It's going to take a really a strong economic hit to really get that inflation down, and so we'll see what happens. But I mean, if that's the case, then they already chose to fight the inflation route. So why stop now? Put us into a recession. So we'll see. But yeah, connect the 2011, 2014, and 2018 bottoms and pull it up. All right, let me take a look for you. 2011, 2014, 2018. Right here, somewhere around here.
Gotcha.
There you go. So then, if you're looking for that, then the $100 level would definitely be support. But at that point, dude, we're already broken through some major levels that we have to hold. Like this area, big pivot point. Big pivot point. So this is an area that we just really can't give up. If we give this area up, then we're in deep shit. So, I like to draw lines to hold price. Hold up. I like to draw lines to hold up price as well, but sometimes it just doesn't work. So we'll see. But I don't know. But taking a look at oil, oil's been one just fucked up trader.
Hey now, come on! I already got yelled at by Bornlom for our sensitivity training.
Oh, that's right. We gotta get HR in here or something.
Exactly. Look, it's a trading pit, man. Walk on our trading pit, and you'll hear way worse.
Yeah, exactly. So, but look, oil saving grace, and it was this $70 area, and it came in as a saving grace. I mean, we briefly pushed below the 2022 open, which is this blue line here that we came down and then rallied through. We're now positive again on the year. But this whole area looking left back in 2021 of December and November, this has been a strong area that we've seen a lot of dip buying come into play, even on the weekly chart. Weekly chart shows a massive area of liquidity and rejection, even looking right here. So, we saw it come down into that area here, and it got bought straight back out of there. Positive sign for oil, but we're still in a bearish active sequence as far as I'm concerned. I mean, you have your swing high, and now we're coming back up to retest a potential lower high, right? So now we'll see, I think oil has a continuation towards like 82 to 84, but then we'll see, does this previous high in this previous liquidity area come into play and knock us back down? Are we going into a recession? There's a lot of factors still in play with oil. That's why I've been trading a lot lighter lately, because there's too many things like China, Russia, Ukraine, the U.S. trying to fill up their SPR, the OPEC trying to cut production. You get the recession coming. It's just a lot of shit that affects oil. Just comes out and just does a bunch of random, hoopla. So, but right now, looking at technicals, you have a pretty clean move up towards 84. So, we'll see if it maintains that. That stands for now. Dollar is probably going to play a little bit of factor into it, but not really. I mean, it typically does because it's based out of the dollar, but it's like Mike said, there's been a little dislocation with the relationship with the Dixie right now, so can't play too much weight onto that. Bitcoin's getting a nice little rampy dampy in here. It's
world's better again,
dude. I tell you, it's not like FTX and all, it's not like every crypto broker's going bankrupt. It's not like you have Sam Fried, whatever the fuck his name is, going to jail for 200 years. Just ignore that. It's like there's a dumpster fire behind you, but you're all happy and go lucky right now. So it's you're getting a little bit of a squeeze with risk on right now. I mean, it's retarded, but regardless, it's still in. It still has a bearish structure to it, so we're just getting a nice little rally in here before it gets knocked back down. So it's just, if you want to take it for what it's worth, and you're seeing a nice rally in Bitcoin, maybe you get a nice rally in the markets. Who knows? But regardless, I wouldn't play too much. I wouldn't put too much, I guess, faith or weight into this Bitcoin rally, because Bitcoin right now, as far as I'm concerned, Bitcoin's going back to its hole where it belongs. And it won't really be relevant with the market anymore, or have that relationship. So have your fun with it for now.
But I mean, come on, man. Who's playing Bitcoin now?
Yeah, well, only people who were once, making a bunch of money with crypto and still hold on to that belief that they can make money with crypto. And it's just, but anyway, that's it for me. We got 15 minutes left until the number. So Mike, you can take it back and, kind of just do your thing and go over what you want.
Yeah, we're getting close, getting ready.
I gotta drain the dragon before we got this freaking Fed coming on. So
I did that already.
Because I gotta
make sure that's a good point, Ty. You gotta make sure you take your pre-Fed dump.
Exactly.
Make sure you get all that nervous energy
because
out.
ass and seat come 2 o'clock to 3:30 or whatever.
Exactly, because we're gonna be like at a heightened awareness. We're gonna be like the guys that sit in and control the nuke buttons.
Yeah,
right?
Exactly. That's right.
Anyhow, I mean, look, with this meeting, we're pretty much it. I think Powell. One thing Powell's been pretty good at is forecasting and basically letting the market know what he's going to do. So I think 50 basis points is a given here, which puts the Fed funds future rate at 4.25 to 450, which, by the way, is the highest since 2007.
Yeah.
And then, from there, the Fed futures rates markets give it a 58% chance for 25 basis points on February 1st, and then 25% chance for 25 basis points on March 22nd. I personally believe that this may be the last one, but we'll see. We'll see. I'm not making a call that this is going to happen here, but I think the Fed may get to a point where they may have to pivot a little bit quicker than they think. But again, it's all about the stupid market. And one thing I agree with Mao is this is just insane, the market we've had. There's no reason for this market to really, be up with a looming possible recession, with where the forward-looking earnings per share is, given where you're going to see earnings really take a hit. So it's just a crazy market. And the problem is is that the stronger the market is, the more the Fed has to do. And it's kind of like the kid that doesn't understand that, right?
Yeah.
But the big thing is what we're looking at. It is we do get a SOEP. We do get a dot plot, so it's going to be an in-depth meeting. The first thing I'm looking at is really going to be from the statements, right? And there's two statements I'm looking at. One is, basically Powell changing from ongoing increases to further increases or some further increases, okay? So I think that right there could, the market could interpret it as dovish. Another statement I'm looking for change is possibly committee anticipates an increase in the target rate will be appropriate rather than, will be, they were pretty much last meeting set in stone that we're going to go to 5% or more and keep it elevated more. So if they start going that it's going to be a more appropriate, then I think market's going to consider it dovish. And see, who knew, these retail traders, they don't have a clue, right? Who knew that you had to sit there and look at and decipher statements and understandings of, ongoing increases to further increases would really make a difference, but it really does. And it all goes back to the what we're talking about with how the market's really trying to decipher these things. Okay, so the dot plot's going to be the big one, though. September, they do a dot plot every quarter, okay? And so this is the last one for this year. Back in September is when we had the last dot plot in SOEP, a statement of economic projections. And, back then they had GDP coming in the year 0.2%. They had unemployment rate 3.8%. They had the PCE at 5.4 with the core at 4.5. With the median terminal rate, which is where they're going to end up at 4.625. Okay, and that was back in September. Now, obviously, there's going to be revisions to that, obviously. And some of the revisions that I'm looking for, I think they're going to keep the unemployment rate definitely higher. Okay, they got it. The biggest problem, the biggest challenge is is wage inflation. Okay, that's the biggest challenge to this Fed right now. It has not come down. I mean, if you look at the JOLTS number, it has consistently been in the 10 to 11 million dollar openings level. So labor is a big problem. Labor is what's holding them back from easing. Labor is what the big deal is right now. So I think what you're going to see is the unemployment rate. They want to scare the markets. They want to keep that high. PCE, by the way, you said what we get the 23rd time?
Yep.
So the PCE, if you look at what some of the numbers we've gotten up to this point, looks like it's going to come in around 4. Looks like it's going to come in, the core is going to come in around 4.6%, which in October it was at 5%. So, and their projections was 4.5. So they're getting what they want, and they're very close to what they projected in their last dot plot. So I think they're going to be happy about that. But, the key to look at, too, in these projections is what I'm looking for is what is going to be their median economic growth for next year. In September, it was 1.2%. I want to see how far they bring that down.
Yeah.
Okay, because again, if the market's switching to looking at the economy and the market's switching at that, then you're going to want to look at that and 1.2%. I think really consensus is about 0.4%. So it'll be interesting to see where that comes in. But and then really what's going to be interesting is what the terminal rate at the end of 23 is going to be. If it's 4.9%, then that's pretty dovish.
Yep.
If it's 5.1 or above, then that's going to be considered hawkish. Okay. So that's what we're kind of looking at. And that's, so we got a couple things to look at. We're looking at the wording. I think, look, if he comes in at 25 basis points, Tyler, just hit the buy button.
Yeah. 100%.
Okay. Buy. It's going to 4,500. Okay. Yeah. If he comes in at 75 basis points, sell.
Yep.
So, I think we're pretty certain that neither one of those scenarios is going to happen,
Yeah.
and that we're going to come in at 50 basis points. But I mean, look, the big thing is that this market, and let's pull up the ES here. This market has pretty much been looking. When he came out and talked, what is it, a week and a half ago?
Yep.
Yeah, when he came out and talked, he was surprisingly dovish. Okay, so any ramp up here that you're seeing is the market participants expecting him to continue along the dove train. I don't expect that, because I think he realizes that he steps in it way too much, because what's happening is you can't have, when the market's going up and the markets are doing their thing, it's not just the stock market, it's all markets, right? So what happens is you're seeing financial conditions ease, and when financial conditions ease, that's not a good thing for what Powell's looking to accomplish. He needs this market down, okay? If anything, he needs the economy down. He needs the market down. They saw what happened. Volcker took his foot off the brakes, and that's why you saw that double dip on the recession angle. And so, Powell does not want to be, doesn't want that. So if the market really wants to go up in 2023, we need to chill out and go down.
Yep. Yeah.
Let him do his job. But I also think that I really feel that he needs to start turning the ship. And I think he started it. I don't think he did it. Maybe he did it intentionally. If he did it intentionally, then you're going to see a little bit more turning of the ship today. So when he had that speech last week, he kind of turned the ship, and it was a little bit more dovish. And I think he's got some more turning of the ship to do.
Yeah.
Okay. And so, we could see, yeah, exactly. He's turning his ship, but he's not, he's not turning it much. And, the question's going to be, does he need to course correct from what he said just, last week or the week before? I forget when that meeting was. I'm getting old here. But that's going to be the key. Is he going to now come back in and just talk this market back down? So we got a lot of things to look at. And just how we traded it on CPI, just let the market do its thing, right? Let the market do its thing. Draw your Fibonacci's. And then let's get ourselves trading, right?
Yep.
And don't forget, 2:30 is the real show. That's when he starts talking and, stuff starts flowing out of his mouth.
That's going to be the fun part. Yeah, because you got the dot plot, which I'll move us originally at 2 in the next 4 minutes, but 2:30 is going to be where we get that direction.
Switch my share here.
Oh man, baby, 3.5 minutes till the dot plot.
I'm gonna switch my share.
So everybody go piss real quick before it starts.
Why did my clock go away? I have a top
That's
clock.
nice.
That gives me the exact timing.
Because you restart your computer. You got to
Oh, I
reopen
did.
that.
Yeah. How do I get my top
bottom
clock?
left, search top clock.
Oh, my God. Got to have my top clock, man.
Yeah.
I don't know. A trader doesn't have it on there.
Oh, man.
What? This is the exact thing I should... Look, see? Shouldn't be doing this crap right before...
That's nice.
Restart my computer.
And 2 minutes and 45 seconds.
Really?
All right, let's get my gold chart set up. Oh my God, gold has a fucking range that could.
No, it's not. I didn't want top. That's the one I hate. That's the other one. I don't know where it is, but you know what? I'm screwed at this point.
Oh my God, 2.5 minutes.
So,
I'm so excited.
I got 1 minute almost. Oh no, you're right. 2.5. See, that's why I hate this.
Where's your damn top clock at?
No, I need the other clock. I forget what it is.
Google clock at the bottom left. I don't know.
No, you gotta have one that's a big fucking yellow letter.
Mikey comes back to start screen and starts hearing order filled.
Oh yeah, don't worry.
Oh my God.
Don't worry about that. Order filled. You're gonna be hearing a lot of those.
Oh, 2 minutes left.
Come on, I'm trying.
Let's get my account pulled up here.
I just want my clock back. That's what I get for restarting my computer.
All right, gold. What we got? What do we got?
Ah, there it is. All right, baby.
Oh, God.
There we go.
Yeah, Will's dumping the loads. Tuned in. You go dump those loads, Will. Gonna make a load while you're dumping loads today. A minute and 15 seconds left.
So, I didn't really get a chance to talk about targets on the ES, but obviously that 4180 level, we're heading right to there, 4200 if we get some good action out of this.
Ooh, excited.
3900 and below is what we're looking at here. And man, I'm already getting some wild swings in this thing. How much time left?
53 seconds.
Trying to get my... Yeah, I want to make sure. Last time, the stuff just like exploded out of the screen.
Yeah, oh, God, man. This is going to be crazy.
All right, stop it. Stop it. Really? See what happens? See what I'm doing 30 minutes before? 30 seconds before. I'm just effing with my charts.
All right.
Here we go. 15 seconds, baby. Do I hit the buy button or sell button?
Right. 12, 11, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
Oh, there we go. That's the initial ratchet. You know what? I'm buying into that.
Oh.
What?
Holy cannoli. Look at that.
I'm trying to see. You see anything?
No, I'm just watching gold just tank here. Damn. All right, numbers came in. Let's see.
50 basis points.
Right, 50 basis point hike. All right, let's see here. See what gold's got in store for us. Kind of just chilling.
Not seeing much.
No. No, me neither.
Still high, playing close attention.
Fed sees path of rate increases continuing through 2023. Median at 4.4% at end of 2022, 5.1% at end of 2023.
Letting the market do its thing. What do you see in tie-in rates and stuff like that? See the dollar soaring.
Yeah, dollar's having a nice little pump in it. Gold's dropping. The rates not really doing anything. I mean, it popped, but it's completely just fallen off. So, dollar's still going. So I'd like to see. I mean, just doesn't seem like much. It seems like people are just kind of waiting for the press conference. I mean, at least on my end. I mean, it looks like the market's continuing, but the gold kind of just hanging out. The Dixie's still continuing. So. Oil dropping off. Yeah, I mean. Pretty much what I expected.
Nice drop into the 200 here.
Most official seat rates ending 2023 between 5 and 5.5%. Right.
So I like to buy. I bought at it off this 200. So this was a nice little buy off the 200. Unfortunately, I'm having trouble with my my chart program. This is just crazy, man.
Nah.
Fed sees core PCE inflation at 3.5% in 2023. Wow.
Interesting.
That's pretty unbelievable. So just letting this market do its thing. I mean, you got rates kind of, they popped up, then they pulled back. You can see in here. The dollar is the interesting part to me, don't you think, Ty?
Yeah, dollar's still. I mean, it's hanging out
VIX
at the highs
is doing
here.
its thing back and forth. Why is this doing this? Sorry, I'm having some technical difficulties again.
On Fed Day?
Right. Oh, you should have that queued.
I know. You having difficulties on Fed Day? Man, it's pretty dead out there. From like gold's kind of just stalled here. So that's kind of weak.
Yeah, I mean, look, I to me, I'm still thinking that there's an upside tilt out of here. But, I'm not ready to just jump in there at this second. I did have a nice dip buy off of this 200 here. You can see this is 200 moving average. So nice bounce off the 200. But, as far as I didn't make as much as I should have made because I'm having issues with my platform.
Yeah.
I think that's why you're not hearing order filled.
Yeah, right.
Yeah, and of course, I'm having issues with my platform.
That's great.
Why would I not be having issues?
Yeah, right. I'm expecting another leg lower on gold here. As we start seeing the Dixie potentially pushing back higher. Yeah, gold's pushing lower here. So I'd expect a little bit further down of a push in gold. Yeah, it is more alarm. Such a soft reaction, but I guess it's really going to be the lingo, what Powell says, the 230, that's really going to drive us. Because, I mean, gold didn't even pay that well. I mean, it's just kind of blech. But here comes the second leg lower on gold, potentially, so... 5-minute closed. Kind of gives that 5-minute range.
I'm looking at the statement. I don't see any dovish tilt on the wording that we were looking at, so they didn't give up the ghost there. I still think 3.5% was higher than I thought they were gonna, given where I see it coming.
Yeah.
Where it was before, but it's still not bad, if you think about it, from 2%. But the Fed's medium view of the Fed funds rate at the end of 23 is 5.1%. I was hoping a little bit lower, but it was 4.6 in September. But I kind of looked at 5.1 as the low end of the median range that I thought the market would be happy with that. So I see nothing in here. I see nothing in here why we should not. Maybe get a rally out of here.
Hawkish revisions on the GDP and inflation as well, Peter says.
Yeah, Peter, what are you seeing? Because again, I'm having trouble with my Bloomberg. What are you seeing on GDP? What did it come in at GDP?
To officials see negative GDP growth in 2023. Most see the economy expanding 0.5% under appropriate policy.
See, again, that's better than expectations. I mean, 0.4% was expectations that I think a lot of market participants were looking at. So if the median's at 0.5, God, no.
I know.
So right now, look at the ES, it's below the 200, so no dip buys for me right now. You got the 10-year still very tame for a
Yeah,
Fed
it's
move.
very, very tame.
It's up, not fading, but very tame. The dollar continues its rise. Oil's dropping off, which is interesting.
Oil, copper had a big spill. Oil's dropping off.
Yeah, so the medium is 0.5, which again, I saw a lot of market participants expecting 0.4 was the whisper number. So I don't see that as being, I know it's different, but it's based, it's a lot lower than what they were looking at, the 1.2. But a lot of market participants were looking for 0.4.
Yep. I know, Borlam. Just wait. The Dixie could hopefully give us that at 230. It's crazy how the Dixie didn't even come close to retracing yesterday's move.
Yeah, this is definitely I tell you what though, we should have been able to easily predict they were going to send the algos were going to send it down,
right?
Based upon just off that first move. Because let's face it, when they hit that, they don't have any way of knowing what's in the dot plots at that point. So that's the initial reaction right there.
100%.
So I'm not seeing anything crazy in this statement right here.
No. Dixie still at highs. ES still at lows. Gold back at lows.
If anybody has a statement, if anybody has the unemployment rate, I'm curious what the median unemployment rate they tagged in there. Well, we're now getting that. We're now back above the 200. So now again, we got about 18 minutes before we got the press conference, and we usually get 3 moves in this Fed. So I think now we can maybe think that we could start drawing in a Fibonacci possibly. Which is interesting, 50% coming right in that 40-51 area. Getting a nice little bounce tie off the 50% area in here.
Yeah.
On the ES.
That's what I'm tracking for gold as well. 15 minutes about to close in 40 seconds. So expect a potential wick fill on the next 15-minute candle. $20, I'd expect another sell-off in gold, giving us that wick fill. All right, 15-minute now closed. So you should expect an initial wick fill for this last 15-minute move. And we're seeing that, starting to see that on gold here. Yeah, Nick, you know what's up. Good stuff, dude. Yeah, this is a nice drop, wasn't it? I got slipped a little bit on that entry, so it was, but gold didn't really end up following through much. But I'm expecting this wick fill to work out. So,
Well, I just bought off the 200 here again.
nice,
So
nice.
I'm getting some nice trades out of here. All playing off this 200 level on the ES. Trying to grab some decent trades here.
That's right. A 5-minute celery, you got it. Very muted action right now, so there's not much action going on. You got 14 minutes until Powell comes out and delivers his presence. I'm still waiting for this gold 15-minute wick fill here. Kind of just chop and grinding very slow.
Definitely some choppy action. I mean, not
Yeah, I
choppy,
mean,
but just slow.
Very slow grind.
Slow grind. I keep on buying and scalping off this 200 area. So I'm just waiting for them to F me on this. Well, I need a higher high here.
Yep.
But I am scalping it. So, I'm scalping in between the Jackson Hole low and the freaking 200 MA. Hey. It's working.
Yeah.
Come on, take me back down, baby. Take me back down. I'll take 7 points in ES every time. Well, Bornholm, I'm glad you're happy that we got that. Spy wasn't a dick for a tick.
Yeah, right.
All right, here we go, Ty. We're going back down to 200 again, which, of course, doesn't make me too confident now.
Yes, grind right now, dude.
So I guess consensus is it was a hawkish statement. So, again, I think the market was leaning a little too dovish in here, but I don't know how they could have been leaning dovish. So, definitely a hawkish statement, but, not really that hawkish as far as I'm concerned.
Yeah.
So, which it's all going to be about the press conference.
Definitely.
Do I dare take it again, Ty?
Oh, man.
Do I dare?
That 200's got to give eventually, huh? Or is it just going to hold eventually?
Well,
and
that's
you get
what
that
I'm saying. I
it's
mean,
like one
you
way or the
know,
other. You get your. Oh my man!
It's kind of course, IWM's kind of breaking out of a bear flag a little bit. So it's I kind of again, I think maybe we go this time.
I'll dig it. I'll dig it.
Come on, IWM's breaking out of this flag. I'm ready to go too.
All right, I'm ready to go.
Are you ready officially?
I'm ready to go. Let's go. Because I think the Dixie's having this nice 1 minute head and shoulders here. So the Dixie, I think, could retrace this move.
See, I'm going to retrace all these profits I just had.
No.
Oh, here we go.
I'm telling you, it's holding, baby. It's holding.
Come on. I'm following the IWM is leading the other indices. So
let's
that's
go.
my whole thesis. Come on.
Let's see if we get this Dixie drop and stop and rock and sock and robots
here. We're just really getting tight in here. Look at this consolidation type. Be careful.
I'm gonna F them.
One way or the other, we're getting F'd.
They're getting F'd. I'm not getting F'd. I'm telling you, it's gonna retrace this move. Because this move was way too light on volume and just like it's just a grind to where people are just waiting for the Fed. And so, come on, let's reset, baby. Come on, let's reset, motherfucker.
Hey, remember sensitivity training. Borderline, I'm sending you into sensitivity training.
I'm gonna send him into sensitivity training.
All right, we're gonna break this, aren't we? Come on. There we go. Come on.
Come on, baby. Come on, baby. Come on. Come to daddy. Come to daddy. Just wait, dude. I'm telling you. Gold and the Dixie are starting to retrace their move. Yeah, I'd be position long too.
I'm position long, but that doesn't mean anything. I got profits to work with, guys. I mean, I see the VIX.
Gold's retracing. Yeah.
Kind of coming down, man. But we are really just kind of...
Dude, it's a grind, man. You got 9 minutes. It would not surprise me if it just sat here for 9 minutes.
Well, you know me. I don't have the patience. I have the patience of a freaking warthog.
A warthog.
Guys, I'm going to sell out my position so you guys can make money.
Thank you. Thank you.
This is just crazy, man.
Thank you. All right, we can make money now, guys. Oh. Damn, dude, it is a fucking grind.
Oh, we got lower highs here kind of developing. Come on. There is a nice little trend line break that we can get here, though.
That's what I'm saying.
Come on. Let's go, baby. Sorry, Ty. I didn't sell yet.
You motherfucker. That's why we're not moving. That's why. That's why we're not moving.
Yeah, Mal, that would F everybody, traders and investors. Like, we ain't going anywhere.
Oh, yeah, dude. That would fuck any people more than it would going somewhere. All right, Mikey, to sell out yet? So we can make some money over here.
No.
The rest of us.
No, I'm waiting.
I guess we can all lose money together then.
Come on, man. What? It's just been a long time. All right, I'm selling.
Thank God.
I can't take it anymore. I can't.
All right, guys, we're going to start moving now. Christ, I can't take it either.
I don't have the patience for this type of action.
Crikey.
Oh, here we go. Look below and go.
Good.
No.
No, I got too excited.
Big bear. Big bear.
Big bear chased me. Come on, Dixie. Fucking Jesus. I mean, what the hell?
Big Bear chase me.
I'm going back to bed. All right. We got 5.5 minutes left, guys.
Come on. Give us an explosive bar out of here.
Jesus. Watching paint dry.
Hey, that's what I do, JT, man. I take one for the team. I'm
oh my
player.
God. Yeah, thanks, Mikey. Come on, dude. What the hell?
Right. I was secretly holding a small position. I'll get out of it.
That's why.
Oh,
That's why.
Man.
All right, now we can move.
Here we go.
Jesus, dude. 5 minutes left. Can we get some volatility, please, coming into play? Come on, retrace this move in 5 minutes. Give me a 5-minute just fuck you bar back to retrace this move.
Here we go.
Oh my goodness. Let's go, baby. Come on, pick it up, pick it up, pick it up. I'm going to start whipping this fucking thing.
Yeah, it's like a horse.
I know. It's trying to like whip it to go faster. Oh my God. Dude, I don't want to, like, it's annoying. If I have to sit here and hold this for 5 minutes and get out right before like he comes out, I'm going to be pissed. Like, give me some kind of just movement before he comes out so I can get out.
Yeah, this is like barcoding action.
I mean, Jesus.
Haven't seen this in a while with the Fed reaction. Of course, after yesterday, you know, this is what we get.
Yeah. We're getting fucked. I can feel it.
Definitely hold. It's interesting how it's holding this 200 moving average here.
Yeah.
I mean, just hanging there. Now, obviously, that's, you know, if it holds it, that's bullish. But we'll see. I mean, we got about 3 minutes, Ty. You want to start ramping up and getting ready for the...
Oh, that's right.
We're going to run the press conference. Of course,
I forgot.
So busy trading. That,
I know.
We forgot. Trading, I don't know what we're trading. It's
all
like
right.
freaking barcode city in here. But.
Right. All right. Alrighty. Gotta stop sharing real quick.
Oh, okay. Sorry about that.
Come on, you're usually not good at sharing. Huh?
I know, I'm not good at
sharing. Stop sharing.
You know that. Come on, baby. Come on, baby. Before the press conference starts, let's get a little pop.
Right.
Get a little pop it up.
All right.
Here we go. This is the bar right here, man. This right here on my 2-minute chart. This is the bar. If this breaks, we're gone. Got this little trend line that we're trying to break through.
Oh man.
All right, all the weak hands out yet?
Yeah, right. All right, guys, minute and 15 seconds left.
Oh, there's Janet Yellen.
Oh, she's up there.
Want to make sure, man. We gotta have Janet Yellen.
Gotta have Yelly up there. Yelly jelly. Alrighty.
You guys better all be happy that I let you guys make money. Come on, break this. Break this.
All right, 38 seconds. Come on, baby. Start reversing ahead of this bitch. Ah, yeah. They said fuck you. "15 seconds. 11, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
Uh-oh.
All right, let's see what.
All right, there's the weekend push out. Let's go.
Right.
Can you guys hear the press conference, guys?
I can't hear it actually, so.
Well, I don't think they've started, right?
Oh, right.
Come on, there's the big liquidity grab. There's the big FU. Shake
Right.
out the weekends. Let's go.
Come on now.
Come on, man. Yeah, he's changing costumes, Mal.
Oh, God. Here we go.
Good afternoon. Before I go into the details of today's
Can you
meeting,
guys hear?
I'd like to underscore
Yeah, let me know
for
if
the
you can hear
American
it.
people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability,
Can
we
you
will
hear?
not achieve a sustained period of strong labor market conditions that
A little low
benefit
in
all.
volume.
Today, the
Let me
FOMC
know if it's
raised
better,
our
guys.
policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
Sorry, can you hear it?
I can hear it. Oh, you know what? I probably
The
didn't
US
share.
economy
Hang
has
on.
slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and
hear it, Mike?
production this quarter.
You hear it?
Growth in
I can.
consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the
Getting
core
a nice
CPI
collapse here, man.
was
Yep.
6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate
there off the
in order
4,000
to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Short-term trade.
Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect policy restraint that
Oh
we're
my
putting in
God.
place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation
This is
back
boring.
down to our 2% goal and to
Yeah.
keep longer-term inflation
the
expectations
hell?
well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the
Here
Fed
we
will
get
do
into
everything
the
we can to achieve our
question and
maximum
answer
employment
session.
and price
Finally, let's
stability
go.
goals. Thank you. I will look forward to your questions.
Go.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned,
That's
it
actually a
is
good
important
question.
that
Right.
overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%.
I mean, stop buying the
We think
market,
the
you
financial
MFers.
conditions
I
have
know.
tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So
Yeah,
what we
see, the
control
market's
is our
buying
policy
that.
moves
Oh,
and the
Jesus
communications that
Christ.
we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina. Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. So
Yeah, what we stopping?
as I've been saying, as we've gone through the course of this year, as we lifted off and got
So
into
guys,
the course of the year,
I
and we saw
redrew
that
my
the,
Fibonacci's to
how
reflect
strong
the new
inflation was and how
low, just
persistent,
below
it was very important
4,000.
to move quickly. In fact,
So
the
40,
speed, the pace
30
with
is
which
my
we're
new
moving was the most
50%.
important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And
Look at
then
that drop in the
at some point,
dollar.
the
Right,
question
I
will become,
know.
How long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and
Wow.
that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy, and that'll be the key thing. But I mean, but for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not as restrictive.
Look at that rejection
enough
at the
stance,
200,
even with
Ty.
today's
Yep.
move, and we've laid out our own our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. That's the biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick. Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But,
Nice
you know,
wick
what you
on
said
the
is
2
broadly
minute.
right, which is
Came
having
down,
moved
challenged
so
the
quickly
wick
and having now so much
3
restraint
bars
that's still in
ago.
the pipeline.
Now
we think
pushing
that
back
the
up.
appropriate thing to do now is to move to a slower pace, and you know, that will allow us to feel our way and you know, and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, you know, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, you know, by now we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see that you see the fact that we've made less progress than expected on inflation. So that's why that
Powell's eyebrows do look like our market charts.
More. And so it didn't go
That's
up by
pretty
much
funny.
in the media, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
In order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You know, you can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be
Dollar's
higher
falling off,
than
Ty.
the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Yeah, there comes Mal. There comes your drop in
I wanted
implied
to make sure I
volatility.
understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on.
He always does that when he's panicked.
To assure a return of inflation to our 2% goal over time. It's not on rate cuts, and we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way: I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
So you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening.
I tell you what,
we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important.
And I think one of the most important statements.
China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber, Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have the we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael.
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of.
All right, nice trade here.
Sufficiently
buying
restrictive.
off the 427,
what our best estimates
which was the yesterday CPI low. We're now back above the 200.
It boils down to
nice
how long
push
do we
out
think
of
this
here.
process is going to take. And of course,
Nice wedge
we
up
welcome
into that level,
these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but think we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I
No.
would say this.
No.
To the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a. So I would put it this way: of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people, and so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions, and I wish there were a completely painless way to restore price stability.
Are we
There
back
isn't.
to this range again,
And
200?
this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That was a good question, actually.
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring that?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with.
You don't want to know
hypotheticals.
that
So
answer.
let me just say.
Let me tell you
we have
that.
to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market's very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, with structural labor shortage, is if you look at where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually. It's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe,
Here's a retracement
it's not our
you
job
asked
to
for,
prescribe
Tom.
things. But I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks. Jennifer?
Nobody tell Powell the market's going up.
Thank you, Chair
please.
Powell.
Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean, what we do is
No.
we make our forecasts and we publish them quarterly. And you know, if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about you know, this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just you know, upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, that, you know, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
All right, we finally got through that. I don't know, Ty, what's your thought process?
I don't even know. Like this freaking it's just like the market didn't even do it. Like it's just like dollars back to where it was, gold's back to where it was. Markets didn't really do anything. I mean, it just it absorbed everything.
You know, pretty hawkish. I mean, I thought it was pretty hawkish presser. I know that everybody's, you know, assuming it was pretty hawkish from the statement standpoint, but I didn't see it. I can see it came in, you know, more in line with what I was expecting. I think a lot of people were expecting that weren't sitting on this crazy, you know, going to be dovish train. So, you know, to me, I think that the fact he said they do not have rate cuts for 2023 projected into their SOP is pretty an important statement, and I think that's going to be a statement to carry weight. Now, what I'll say is, even though this was hawkish, my big thing is that we have options. We have quad witching on Friday. So, and this is the largest we've ever had. Okay, so there's a lot of nominal value. I know a lot of calls sitting down at the 4,000 level. So, you know, I don't know. I don't know where we go from here, but I know that I would be very careful trying to assume too much out of this.
Yeah, 100%.
You know, even though we came in pretty hawkish, doesn't mean that we're going to completely fall apart in here.
Yeah. Yeah. So
that's kind of my take on it. Just real quick, I'll share my trading screen here. Interesting levels that kind of came in play in here. You had the 4,000 level, gave a great trade. You had obviously the 200 moving average gave a great trade. And this level, CPI low yesterday, this wedge up into this was a really decent trade. So
Mhm.
you can see this nice little wedge up into the CPI. You had a lot of wicks standing up here, and they kind of exploded on the break out of here, and then took it up to this high. So that was a nice trade. So a couple good trade setups in there, but nothing crazy like we typically see, right? I mean, it just pretty mellow and pretty tame in my
Yeah.
regards.
No, I agree. It's pretty blech. But
Yeah, but I guess we'll see what the market does from here. Pressure's over. Remember, you typically get the three moves. You get the reactionary, you get the counter trend, and then you get the real move. So I guess we'll see what happens here with the real move.
yeah, we'll see.
But it was fun. I had fun.
Yeah, it was fun regardless being on here with you guys. It was a pleasure as always.
Yeah, and they're killing the theta. They're killing the premiums on the options. That's why, I'm not in them.
Yeah.
I'm in the futures. Getting wicked around.
Exactly. Alrighty. Well, thanks guys. Thanks for hanging in there with us. Thanks for tuning in. It's been a pleasure, regardless whether the market did nothing or not. But it was fun. Have a good rest of your trading day. Have a good rest of your day in general. And yeah, we'll see you later, guys.
See you later, guys. Safe trading.